some startups that were begun in, say, 2018 or 2019 and grew up in the era of low interest rates, their business models may not work as well in an era of high interest rates, or they're unable to pivot to this new interest rate environment. And so that's where the startup shutdowns data kind of has continually risen quarter over quarter. So a lot of companies are trying all of these strategies to get to revenue, profitability, being able to control their own destiny. It's just that not all of them are able to do it.
So which means that, are you predicting that more startups will shut down in 2024? And it's like the rate has started to increase. It's going to accelerate, I guess.
Yes. Unfortunately, I think that's the case. Yeah.
Good day to all the SaaS thrivers. I hope you're doing good. Our today's topic is our startups reacting to the increased time between venture rounds. Before I introduce the guest, I want to share a little bit about the topic, how this topic came into being. We recently posted on the blog titled, "Are VCs Incentivizing Startups to Grow at All Costs?" And funnily enough, we saw a lot of VCs subscribe to our Substack. Upwards of 100 people signed up, 100 VCs signed up onto the Substack on the same day when the post went live. Some of them actually sent us notes, including, hey, can you also include data insights from Carta and PitchBook? And here's what happened. PitchBook data was very hard to come by. We had to spend a lot of time to peruse, but the good thing was that we found that Carta data sources to be much more cleaner, open, and easy to understand. So please fasten your seat belts and put your trays to the upright position, because we are now about to take off on a wild ride with the one and only, the legend in the making, Peter Walker from Carta. Peter, some say you are a wizard of equity evangelism. Some others also say, and I've seen that post on Twitter, that you are the primary startup doomsday predictor. You've been talking a lot about startups being failing. But I think, Peter, you describe yourself as the data storyteller. Yeah, that's very interesting. Just to give you a quick note to our listeners, I've been a fanboy to Peter's LinkedIn post for about a year or so, more so because he asks a question and then he answers it. He doesn't keep me in limbo for too long. So some of my favorite posts are the following. On March 21st, he asked, was 2023 really that bad for the US startup shutdowns? And he answered, yes. On March 13th, he asked, why are pre-seed SaaS founders giving less equity to advisors? And he answered, well, advisors are dime a dozen. Of course, he didn't say that exactly, but that's my embellishment. On March 17th, he asked, startup class of 2018, where are they now? And he said, 49% of them are dead. Although some of this are a lot more embellishments, just want to keep the topic light. But that brings us to the topic. How are startups reacting to the increased time between venture rounds? Peter, welcome to the podcast. How are you?
I'm doing great, Guru. That was an involved introduction. I'm not sure I agree with all of my various titles, but it's good to be here.
Here's one more. By the way, I asked ChatGPT to tell a little more about you, and it wrote back the following. Peter, in his spare time, is teaching his pet parrot how to calculate complex equity distributions. Is that true?
Not yet, but it sounds like a good use of my time. Maybe I should buy it and get started. I'm glad ChatGPT can hallucinate about me as well as it can hallucinate about other people. Okay.
That's good.
I heard it before.
Yeah. So let's get into the topic. So Peter, I know you've been a prolific LinkedIn poster, if that's even a term. Yeah. Primarily about, what's happening in the startup world. There's a lot of data that Carta collects, and you surface it out in terms of charts, in terms of articles, and so on and so forth. Yep. Could you tell a little more about what's happening out there, especially about the failure rates of the startups? And one of your favorite posts where you got a lot of people commenting is about the typical time between the investment rounds, and that seems to be increasing. So tell us a little about both the failures, what's happening there, and because of that, what's happening in investment rounds.
I think it's important to maybe start with a little bit of broader context just on the VC market in the US overall. At least on Carta, where we have about 40,000, maybe a little bit more than that, startups that use us for cap table. When we look across that population, which is a sizable portion of the overall US startup market, we see that venture funding peaked in 2021, and then it's just gone down quite significantly since then. It's something like Carta startups in the last quarter of 21 versus say 13 or 14 billion in the last quarter of 2023. So it's a 80% drop. So it's no surprise when you take that into account that the timelines between venture rounds are lengthening. Obviously, if there are fewer rounds happening, then your average Series A founder is going to have to wait longer to get to their Series B. There's a whole host of things that are happening in between those rounds. There's bridges and extensions and people trying to take in all sorts of creative financing. But in general, I think it's easy. The sort of standard way to say it is, it used to be the advice was it's going to take you 18 to 24 months between each of these rounds. If you look, like, the gap between a Series A and a Series B in the US right now in 2023 is now taking over 2 years, the median, and the average is taking much higher than that. So if you are planning on fundraising again in 18 months, the advice would be you should anticipate that it's going to take longer than that in between these rounds, and you're going to have to make the money that you already have last longer. And then we can get into a little bit about the shutdowns that have happened recently and kind of that side of the market as well.
Yeah, I think that's an interesting, an opening remark that you mentioned about. Could you maybe tell a little bit about, well, there seems to be that there's still a lot of money. Some people call it as the dry powder out there in the market, right? So we still have a lot of money.
Yep.
Is it that they are holding back on funding these startups? Or is it that they are doing more due diligence? Or they're expecting, because of the ZIRP or the zero interest rate, coming in, they're expecting. So what's happening? If there's so much money in the market, why is it not delved out to the startups?
It's a great question. There is a lot of opinions about whether or not that dry powder is ever going to result into anything. I think the way that I think about it is twofold. First, yes, VCs are deploying capital more slowly. They slowed down the pace of investment in middle of 2022, and they have not really picked back up, although maybe in the first quarter of 24, things are looking a little better. Second, VCs are deploying that capital for the dollars that they are putting to work. They're deploying a lot of it into bridge rounds or extensions for current portfolio companies. So instead of making a new bet on a new company, they're giving more money to companies they've already invested in to keep them alive through this struggling period. So a lot of that dry powder is going to go to current portfolio companies. But I think the last part is maybe the biggest thing. The part of the venture market that's been hit the worst is the late stage venture market. Series D, Series E, on and closer to IPO. Those are the rounds that take in 50, 75, 100 million or more in an individual round. If those rounds don't come back, then a lot of that dry powder is just going to remain dry powder and it's not going to be used. It's impossible for VCs to take all of that money that they were going to give to late stage firms and instead give it to early stage firms. Yeah. There's just not enough early stage companies to make that work. It just, the math doesn't work on the venture economics. So the early part of the market is still holding up decently well, but the late part of the market has been really dry.
Okay, so that's good. And to the listeners, we'll actually post out some of these snippets from Carta's data insights into the blog post as well. I read this one will be titled as How Long Until the Next Round? And whatever Peter described, you will have it in the blog post. So Peter, could you maybe share a little bit, right? So if late fund or late stage venture funding is slowing down, more so because of valuations and whatever that might be, there's still capital available to the VCs. They can't deploy to the early stage companies. There's not so many companies, and even if there are many companies, they're not going to increase the valuation and pay them and put in it. Instead of they asking for 5 million, they're not going to let triple or four times of that and do that, right? So they're still going to be a lot more logical about it. What strategies do you see out there that companies are adopting to mitigate this risk that they are an early stage company and they're trying to raise the next round, but the lengthened times between rounds is throwing them off? Like you mentioned in your early opening remarks, is that typical time was about 16 to 18 months of time. Now it has gone beyond 24 months.
Yep.
So how are they coping up with this increased length of time between the rounds?
There's a lot of different strategies that early stage companies are employing in order to get over this funding dearth. A couple of them are pretty obvious with all of the headlines around layoffs. Those layoffs are not just happening in big tech companies like Google. They're also happening for private startups as well. There's been a lot more layoff behavior over the last 18 months. The flip side of that is hiring has also declined quite a lot. So it used to be on Carta, at least in 2022, all the companies in Carta collectively, they hired about 500,000 employees, so 500,000 people. Then 2023, they only hired about 265,000 employees. So basically half as many hires. So there's layoffs happening, which obviously cut payroll, and then that payroll is not being expanded again with new hires. These early stage companies are trying to do more with fewer headcount. So that's one, is just how are you thinking about your compensation, your payroll, which payroll is almost always the biggest cost in any of these startups. The second is, of course, scrutinizing software spend. I can speak personally at Carta. We have definitely clamped down on using new tools. all of the new potential tools that we're using are going under much more scrutiny than they used to. So making sure that you are only spending as much as you need to on software or a cloud hosting, et cetera, as possible is a route that startups are going. And then, of course, a lot of these startups are trying to take in, maybe they can't raise a Series B right now, but they're going to take in a little bit of a bridge or extension funding, either through priced equity or through safes or convertible notes, or maybe even crowdfunding in some cases, doing anything they can to get a little bit more capital in the door so that they can stay alive. In the terminology of the Paul Graham from YC, they want to become default alive. Now, there's a lot of companies, and you've heard this all over the place, that are trying to get to revenue funded. So can I generate enough revenue where I don't actually need to fundraise? And I can just perpetuate this company through the customer revenue that I'm bringing in. And maybe I fundraise down the road if I really want to pour gasoline on things. That's a fantastic strategy. There's a lot of companies that are just not able to get there quickly enough. And so, unfortunately, we are seeing more and more companies go out of business as well.
Let me reduce it, at least in my head, what you just said. So about like 5 or 6 strategies that you mentioned. Layoffs, changing in the compensation structure, is going to reduce the spend in one way or the other, right? So that's one strategy. And we've seen that a lot more often. You said about bridge funds and other kind of maybe even lighter equity funds or even debt funding has started to increase. And we've seen that from various banks talking about it. Hiring has slowed down, which directly relates to reducing the compensation, the spend on people. You mentioned about the software, the infrastructure costs are getting capped or getting reduced, which is where we see more and more sales are slowing down. Many of the startups wanted to go fast. We're hiring a lot more sales guys. They were trying to push for their products, but the buyers are not buying that in as much as possible.
Yeah.
And I want to talk a little bit about that. So it's a two-way market, right? So if the SaaS builders are reducing the spend on typically areas which are not related to GTM, right? R&D and all of that, but they're increasing their funds on sales and marketing with the hope that they will still be able to grow, right? And I saw some of that post, and these are two really different things, right? So on one hand, we are saying that the software companies and the SaaS builders are reducing their compensation, laying off people. On the other hand, we are saying they're increasing the funds in sales and marketing, right? With the hope that they can grow faster. These compete with each other. And the last one is about profitability and revenue that you were mentioning. So is the market hanging on to a hope cycle at this moment that we will reduce all of the compensation across the board, keep the spending high on sales and marketing with the hope that will generate revenue, and with the hope that by generating that revenue, they will become a lot more profitable or a lot more efficient, if you will. So how do you see that?
I mean, I think a lot of people are trying it, but to your point, it's really a question of how much time can you actually gain from that. So the market shifted in mid 2022. So it's been a solid year and a half since the downturn really started within venture. A lot of companies have already gone to their current investors and asked for bridges and extensions. And their investors, in many cases, were amenable to that in some cases. If there was a 20 portfolio companies in a given fund, maybe they only assisted 3 or 5 or 6 of them, but they've made sort of their double down bets. They've done the extensions that they thought were worthwhile. And so that, I think, is why we're seeing more startups shut down now, is because there was a period where people were saying, look, we're going to give you a little bit more cash. We're going to make all these changes with the cost structure of the business to hope to get to revenue funding soon. But some startups that were begun in, say, 2018 or 2019 and grew up in the era of low interest rates, their business models may not work as well in an era of high interest rates, or they're unable to pivot to this new interest rate environment. And so that's where the startup shutdowns data kind of has continually risen quarter over quarter. So a lot of companies are trying all of these strategies to get to revenue, profitability, being able to control their own destiny. It's just that not all of them are able to do it.
So which means that, are you predicting that more startups will shut down in 2024? And it's like the rate has started to increase. It's going to accelerate, I guess.
Yes. Unfortunately, I think that's the case. Yeah. I think 2024 will be a year that feels very confusing and odd to people because there's going to be more funding. I think funding for total startup funding is going to increase again. So it'll feel a little bit more buoyant or optimistic in that way. But on the other side, a lot of companies are also going to shut down. And so it'll kind of feel, the way that we talk about it here is it's a very difficult time to grow a company, but it is a wonderful time to start one. because there's a lot of capital available, and perhaps you can begin in this era of high interest rates and you are really, really conservative with how you're growing your team and trying to get to revenue as quickly as possible. And that sets you up for a better growth path in the future if you found the company today.
Got it. And I think that makes perfect sense as well. The capital that you raise, it still takes about 3 quarters to 4 quarters time to distribute it, apply it, and make it work.
Yeah.
So let me ask a slightly different question.
Yeah.
If we see that we're predicting that there'll be more shutdowns, we also see that the compensations have started to change quite a bit. Departmental hiring has taken a hit. Could you tell us a little more about, I know Carta published or is about to publish the State of Compensation report. Could you give some insights on what do you see out there? Which departments are getting affected? Is hiring stopped across the board, or is it open to some areas? Are layoffs happening across the board, across all departments within the SaaS company? Or is it only relegated to a couple of areas? What do you see out there?
Absolutely. So yeah, that State of Startup Compensation report for the second half of 2023 is live now. So people can go to carta.com/blog and it'll be the first one that pops up. There's a whole host of data in there. I'll focus on maybe 3 key points. So to your question about layoffs impacted every single function across early stage startups, from engineering to product to sales to customer success, all over the place. Some a little bit more than others. I think customer success in particular was hit fairly hard. In terms of new hiring is picking back up for engineering and sales in particular. Engineering itself is making up close to about 30% of new hires in 2023. I think that's going to get a little higher in 2024. Sales is something like 17 or 18% of all new hires. And then the other type of thing that's happening is that there's been an increased focus from startups on hiring individual contributors. So instead of hiring managers or executives, a lot more of the hiring is happening now on ICs who will actually get in there and do the work themselves and don't require like a high number of teammates in order to get things done. So that's kind of the shift in the hiring market. When it comes to the compensation, which is maybe the other key finding from this report, if you just take salaries, they're essentially flat, you could say, from the beginning of 2023. Maybe a tiny bit up, less than 1% on average, which of course that's better than falling, but it's certainly not keeping pace with inflation. If you look at equity compensation, that's where the real change has come in. So the average equity package for a new employee hired today versus the new employee hired in November of 2022, the employee that's getting their equity today is receiving about 36% less equity. And that's not based on the company being worth less. It's literally just fewer shares of the company. It's a big, big, big shift.
So 36%, sorry, let me understand this. 36% less equity because the valuations are less? Or is it just the number of shares that they're getting, regardless of what the valuation is less?
The latter, yes. The number of shares has fallen. So you can think of it as, if we consider equity as this big pie, the pie has gotten smaller. Yes, the valuations are down, but also each individual employee is getting a smaller sliver of pie. Their slice has been reduced as well.
Got it. So let me understand this. Hiring has started to happen a lot more in the R&D, which is a good sign because the products get better because of it. GTMs, even though the layoffs were very high, early on, it has picked up with 15 to 17%. All of the GTM functions, AEs, STRs, all of that. All the support functions seem to be taking a major hit. And by the way, I don't have access to the report yet, but for the listeners, we will get that and we'll probably even put a mind map on each of these functions and work with Peter to bring that to the fore. But it looks like, Peter, all the support functions, customer support, success, are taking a hit and there's a reduction in headcount. The general salaries, the total packages that new employees receive, that has gone down as the total, even though the cash component might pretty much remain the same, the equity is way down 30, 35 to 36% or so. A lot more ICs, less managers. I'm guessing less advisors as well.
We were advisors for the earliest companies. Still a decent amount of advisors being granted equity, but the equity packages are pretty small at that stage for advisors.
It looks like in that case, the leadership is rolling up their sleeves in general and acting as now the first level and the second level managers. Whereas earlier they could have hired a manager in play. Now they're rolling up the sleeves and acting as the first level, second level, even third level managers. That's in general a good thing because they're at least getting their company in line to where the market should be. One last question on this particular aspect. Do you see any of these improving? Are there any signs that you see improving, especially with the support functions? I know there's a lot of hullabaloo about customer success going down because that's really needed for retention. And now because it goes down, retention is not going to happen, which means the growth or the NRR rates are going to come down very soon.
Yeah.
Do you see these picking up? Or is the market shifting more and more towards allowing the product do the talking, product do the selling, rather than the sales and the marketing and the support trying to do the selling and the retention? It was a very heavy-handed approach because it required a lot of personnel.
Yeah.
So is that shift slowly starting to happen towards more product-led, if you will, or self-service, or is that not yet a true sign out there from the data that you see?
I wouldn't be able to say whether or not there's been a dramatic shift towards PLG as a motion for companies that were used to be very sales-led or sales-driven. I still think that there's going to be a heavy component of sales across many SaaS companies. When you say, how are these trending? I think it's a big open question. In this era of scrutinizing headcount very closely, I wouldn't be surprised if 2022 remains the peak for startup hiring for quite a long time. There's a current approach that's been widely adopted in the market that you should only expand headcount when you absolutely need to, and that you want to increase the amount of revenue per employee as a metric of health for the business. I think that's generally a good thing, but there is this idea that if we want more people to have the ability to try their hand at startups and learn and experience what startups are really like, of course, they need to be hired into them. So there's a balance there. I will say that at the smallest stage companies, they are being much more considerate about how quickly they grow headcount. So for instance, if you take the median seed stage company, it used to be perhaps they would raise their price seed round and they'd have 10 or 12 employees. The ones that are raising their price seed rounds now are more like 7 or 8 employees. It doesn't sound like a lot, but if you expand that out as they grow through their fundraising journey, I think you are going to see people or companies a lot more headcount discipline than they used to in the past.
That's a good thing, right? That's going back to the roots and going back to being very efficient. I know there's a lot of doomsday conversation that we just had, so I want to maybe take it down to a slightly lighter note. Any advice that you want to provide to these early stage founders out there who are going through this particular pain, especially many of our listeners, and we have a lot of them. It's about 50,000 odd subscribers now, almost 50-60% of them are early stage startup founders and so on and so forth.
Sure.
Any advice that you want to give to them, as well as the GTM and the growth professionals who have been hit pretty badly in the last 1 or 2 years' time? Yeah. Now, from the previously sales-led or 100% sales-led company, where they are now reducing the headcount and figuring out how they should manage that. Any advice to them? So founders, engineering teams, growth professionals, customer support, or
Sure.
success leaders, what advice do you have them?
Look, on the GTM side, I think there's a lot of headlines around how AI, in particular, the tooling around AI, is going to eliminate the need for these positions moving forward. I don't know if I fully agree with that, but I do think that they will radically shift the quality and content of the day-to-day work within those positions. So if you're not getting familiar with how AI is impacting your org, marketing and my org, or for instance, customer success or sales, I think it's absolutely critical that you start doing so. On the founder side, there's a lot of advice or sort of benchmarks that we can help with when it comes to valuations or fundraising, et cetera. I will say this for pre-seed and seed companies in particular. If you're not familiar with SAFE, Simple Agreements for Future Equity, that is the default instrument for fundraising for pre-seed companies across Carta in the US these days. It's about 80% of all the money given to pre-seed companies is going through a SAFE. So one, definitely get familiar with SAFEs. You can run them through Carta for free if you like on carta.com/launch. But two, and more importantly, SAFEs can feel like a very easy and almost free version of getting money in the door. You're promising equity in the future for dollars today. And it can feel very simple and very clean. One note of caution, we are seeing folks who have raised a lot of money on SAFEs, maybe at different valuation caps or from a lot of different people, and then they go to raise their first price round, and they've ended up giving up more of their company than they anticipated doing. So it is important, while SAFEs are a wonderful instrument, they are not without any risk, and you should be aware of how much of your company you're actually selling to these SAFE investors before you just continually fundraise on small checks on SAFEs. So that's something that wasn't actually much of a problem in the pre-pandemic times, but SAFEs have just become so much more common that they're starting to show a little bit of cracks on the edges.
Got it. So maybe on the topic of the safes, is it because of the confusion between post-money safe and pre-money safe? Is that the prime reason for that valuation and then equity to slip away?
I think that's definitely part of it. So the post-money safe has become the default instrument. It used to be that pre-money safes were much more common. They've become less common in the last few years, probably because Y Combinator changed their default docs from pre-money to post-money. It's not like a moral judgment. They're both good instruments to fundraise on. But the big difference is if you raise money on post-money safes, you are guaranteeing that safe investor a percentage of ownership. So if I raise $1 million on a $10 million valuation cap on a post-money safe, I have just sold 10% of my company, no matter what else happens with fundraising whenever you get to that price round. So if you do that a couple times and you guarantee this tranche 10% and this tranche 5% and this tranche 3%, then you come to the eventual price round and none of those get diluted by any price round investors. They own that share of the company. And so you as the founder may end up with less than you anticipated or ideally would like. Not saying there's one right way or wrong way to do it, but it used to be that founders would only raise $200,000, $300,000, $400,000 on safes. And now we're seeing founders raise millions of dollars on safes occasionally and multiple different safe rounds. So that part of the market has just gotten more complex.
So that's a great closing note. So let me summarize. You mentioned really 3 words of advice. The first one being founders, be patient. These are hard times, so definitely be patient. You mentioned earlier that hiring discipline needs to be brought back in. It is coming through, but early stage founders, please don't hire people unnecessarily. It looks like the trend is back. The founders, the leaders are rolling up their sleeves and becoming first level, second level, third level managers. So that's probably a good trend, at least to be a little more efficient in the beginning. And then last advice that Peter, you delved out is instead of getting the confusion between pre-money and post-money, choose the post-money. And that gives maybe peace of mind to both the investors and the founders, and does not dilute you, or at least you don't feel that equity is slipping away from their own. Well, that's great advice. Thank you, Peter. It was great learning experience from these conversations. I definitely enjoyed a lot. I hope the listeners enjoyed. Peter, thank you so much.
Absolutely. I'll have to go get my parrot now.
All right, on to ChatGPT Parrot. Thank you, guys.
Cheers. Thanks for having me.